Good evening, members. Welcome to the CPE Study Circle Meet. Today's topic is Audit Quality Maturity Model. For this topic, to handle this session, we have a very eminent speaker, Mr. Jaideep Trasi. I welcome you, sir. I request Chairman of Bangalore branch to escort the speaker onto the dais. I request the chairman to hand over a floral bouquet. I request chairman to give a welcome address.
CA Jaideep Trasi, CA Pramod, Secretary, and my dear professional colleagues. Welcome you all for this very interesting session on audit quality maturity model. It's an upcoming law going to be implemented from 1st April 2023. Lot of firms, companies, those are doing a special audits like a listed entity, bank and insurance company. They will come under the radar of AQMM. And before going to the peer review, they have to get reviewed by this AQMM reviewers. And based on the points, what is the quality is involved. It's all, we can say that to review the quality of the audits and where the public money is involved in the public sector company, ensure that all the statutory aspects has been complied. They're making little stringent and strict in conducting the audit and to maintain the quality of the audits. In that manner, they have come up this law. It is going to be implemented from 1st April 2023. On this topic, we need to, those are involved in those kind of companies, they have to update themselves. As we know, generally those kind of companies will only go to majority big fours only. Small and medium firms will not be involved in those kind of audits. But still, lot of groundwork needs to be done, and we have to be geared up for that audit IQM model. Enlighten us, we have with us a very eminent speaker, Jaideep Trasi, having more than 20 years of experience in audits. He is a better person to enlighten us on this topic. We are eager to listen to him. Once again, I welcome you and welcome you, sir, and welcome you all for this program. Thank you. Over to Secretary.
Thank you, Chairman. I take a privilege in introducing CA Jaideep Trasi. He is an associate member of ICA and graduate business management. He has more than 21 years of post-qualification experience in a large firm and is currently a partner in the audit assurance practice. His experience covers various industry sectors covering manufacturing, engineering, food processing, consumer durables, technology, and telecommunication, healthcare, outsourcing services, and other consultancy sectors. Mr. Jaideep has an experience in performing statutory audits and tax audits, including the group reporting audits, equity listing engagements, special agreed upon procedures, and other transaction related to due diligence services for a large Indian and multinational companies. He has had the opportunity to work with and interact with the audit practitioners in United States, UK, Singapore, Japan, Korea, and possesses a core technical skills in financial reporting, international auditing practice, and finalizing statutory audits as per IFRS, US GAAP, Singapore FRS, in addition to Ind AS and Indian GAAP. He is a member of his firm's internal training and the quality review team. With this brief introduction, I welcome you again, Mr. Jaideep. I think now, without wasting much of the time, I think I will leave you and participants. Over to you.
Good evening to everyone. Now, when we start talking about audit quality maturity model, I think I would like to cover it in three aspects. Principally, current status of how audits are going on, what were the expectations from regulators and markets, and how finally are the requirements and what is it that AQMM actually requires us to do. From a current status of audit, if you look at the last 2 decades, first one that hit us, and these are just some of the large ones, these are not the only ones. There must be a few hundreds of instances where the auditors are pulled out, called, asked to respond to the public and regulators on what's happening on those companies. But if I look at 20 years ago, first thing that actually hit largely was the Enron scandal. This was again all accounting jugglery. A lot of things that should have been identified by the auditors, should have been reported on by the auditors, but were accused of not having done so. Impact, a firm that was one of the largest global MNCs ceased to exist. That was the overall impact on the auditors. It was the impact on the reputation. There were penalties to be paid. And as a brand, they were wiped off from the globe. So the impact that could come on auditors is significant. The other one that happened a few years later, 2008, was the Lehman Brothers scandal. This also resulted in what was known as another global depression across, where because of the way things were done, they were working out unique derivatives and other aspects. Again, a lot of numbers on the books. Nobody knew what was supporting it. Again, auditors had not come up with anything. The final testing evaluation did say that the auditors had not performed up to par. And again, impact resulted in new IFRS standards coming out. That was the first year they looked at bringing in what was at that point in time ISA 701. That is the key audit matters requirement was being discussed. That became a new requirement. Of course, it got deferred as far as implementation was concerned, but these are the changes that came in from those periods, saying an auditor has to explain. The public needs to know what is it that the auditor is doing while they carry out their activities, what are the key areas of their concern, and therefore a requirement of key audit matters was brought up. Of course, we cannot miss what happened in India. Next thing was Satyam. Again, the same concerns as to whether the audit procedures that were being carried out were adequate. Had it not been for the confession given by the then CEO, would this have been found out by the auditors? Again, these are all questions. Impact, again, it hit the brand of the firm that was signing it. So, SEBI came out with a 2-year ban. Of course, it was argued and fought by the firms, but this all impacts their overall brand. Again, the entire Companies Act underwent a change in India. They felt the Act of 1956 was not adequate to address it. 2013 came up, a lot of new amendments. The auditing standards underwent a change in the sense that the Indian standards were lined up to the international standards. If you look at it, 2010, all the auditing standards in India underwent a change and they were mapped to the international ones. There were regulatory changes that were happening in India. You had the NFRA getting formed, a lot of review. Otherwise, it was just the institute reviewing us. So these small instances brought about significant changes. Even then, it's considered that we are still not where we need to be. And therefore, AQMM is the resulting impact. What happened because of all these instances? A lot of accounting standards underwent a change. The previously existing international standards on accounting, you had IFRSs coming out newly, making the necessary changes to the existing standards. Similarly, in the US GAAP kept undergoing lots of revisions. Of course, in case of US, they don't come out newly, they just replace the existing with the same numbers. So that kept happening with ours all over the place, saying revised standards. Regulations started changing here in India. More and more responsibility kept putting on the directors as to what independent directors should start looking at, focusing at, what the responsibilities were. Lot of scrutiny on related party transactions. Again, because that is what, Enron was the same, transactions with subsidiaries. So similarly, coming back in, focus on related party transactions. Additional disclosure requirements, both on the financial statements with the revisions that happened in the Schedule 6 at point in time with revised Schedule 6 followed up by Schedule 3, the amendments now that again happened on Schedule 3, revisions in the board report formats, additional disclosures being required, BRS are now coming into play. Changes within enactments itself, one we also discussed, the Companies Act, amendments made because of NFRA coming into play, the compositions, responsibilities of what is happening. And if people have looked on the NFRA websites, the kind of reports that they're issuing, the questions that they're putting forth to the various audit firms are quite concerning. There's also been a revision that came in from the ICA's peer review requirements. One is, of course, the AQMM coming into play. It also comes into the scope of the peer reviewer as it goes. And of course, increased scrutiny by SEBI themselves. That's happening with the way the listed companies are giving information, not providing information. You actually have a specific investigation cell within SEBI, which starts looking at all the quarterly results, the annual results, looks at the final annual report, looks at the ambiguity within the quarterly results and sends out questions. And of course, there's increased responsibility on auditors. The 143.12 reporting is, of course, there. The requirement of compliance with instances of non-compliance with laws and regulations, or what is known as more as NOCLAR. These are additional responsibilities on the auditors, which means unlike previously where fraud considerations were just an element of auditors' planning, it has required a lot more focus, though yes, it is still overall principles of audit. We are not obligated to look for and find fraud, but we are obligated to sufficiently plan our processes to identify if there's any possibility of fraud. And if such possibility is identified, to report it not just to management, but also to the regulators. There is increased focus on auditors. One was, of course, from a peer review that is happening. Also, the peer review requirement is extended further. This was more specific technical professional practices being done on specific engagements. Now that the AQMM also falls under them, it will expand onto the entire practice. So it's not just specific files that we'll be looking at. You have the FRRB, which looks at securing compliance with accounting standards, whether everything, all the disclosures that are required to be done are being made or no. And these are also, if the inconsistencies are found, this again falls back on the auditor to respond. You also have the QRB, which looks at specific quality review of the practices that the firms were having. And now the new NFRA also, which looks both from an accounting standard compliance as well as auditing standard compliance, their scope extending not just to companies, but more significantly to the auditors. So between these four, there's extensive oversight on what an auditor needs to do. More importantly, how the auditor needs to behave. Now there was, what Debashish said some time back, I think earlier this year, where he did say the statement that audit is a serious business. And if you cannot meet the expectation gap, one should stay away from it. Which means unless you are clear that you can meet up to what is expectation of market, regulators, the profession, one should not get into audit. Now it's very easy to say, you should be able to meet an expectation gap. So the question is, what is this gap? And is it ever possible to actually fulfill or reduce this gap to a minuscule difference? It's very difficult because the cause for the expectation gap is significant. Now, what is expectation gap? Now, is this something new? No. There was actually a commission in 1978 which looked at what the expectation gap was. And they came up with a study as what is expectation gap, that is between what the public perceives or auditor should be doing and what the auditor perceives as what they're capable of doing. And there's always this gap. And it's very difficult to bridge the gap because the public expects that the auditor should be able to tell them whether they should be investing in something or not. But we never give that advice. That is not our professional responsibility. But they expect your auditor to be able to tell whether the business is going up, improving, should they be investing, will the company make a loss, will the share prices come down, to the point that if you ever go out, meet the public and, by whatever reason, introduce yourself as a chartered accountant, there are two questions that always get asked. How do you read the balance sheet? Should I be investing in this company? And two, how can you save my taxes? So principally, these are the two things that a chartered accountant is known for. Being able to judge which company is doing really well, and therefore somebody can invest their money. Another one is to save their money by reducing their taxes. But if you look back at it, when we look at, as a chartered accountant, when you read a balance sheet, you don't read a balance sheet to decide whether somebody should be investing or not investing. It's just to make sure that the information available there is sufficient for the other party to decide on their own. So there's a expectation gap there as well. Then again in the 90s, there was another person who did another study to figure out what or how can we further split this gap. So they brought it out in two aspects. One is where the society's expectations are coming in between what can be accomplished and not, and what the performance levels of the auditors are. And there were two aspects to it. One is the public's knowledge of what are the regulations under which the auditor is carrying it out, which means their extent of knowledge of the Companies Act, their extent and knowledge of the accounting standards, their extent and knowledge of what it is possible or needed to be done under the auditing standards. Now, unless the public are also chartered accountants or at least commerce graduates, their extent of knowledge on these aspects is minimal to zero. So that is one cause of expectation gap, because they don't know what is it that you are doing, under what criteria or expectations are you performing, and therefore their expectations have got nothing to do with your capability. This again goes similar to saying, when they come to a doctor, the patient comes in expecting the doctor will save. Whatever it may be, it could be 4th stage of cancer. But when they come to the doctor, the expectation is doctor is gone. Now that I'm here, you have to save me. It's only the people in the medical profession will probably be able to say, is this patient at a point where something can be done, or is it totally out of their hands? Even the most proficient doctor, after completing the surgery, comes and says, the rest is left to God. Because even they don't know what they've done is going to be successful enough, because till the patient wakes up subsequently and everything is fine, nobody can predict whether things are going to go. So holding those expectations is similarly, it comes to an audit. Just because I've completed my audit and I've signed off on the financial statements, does it mean everything is clean? Not necessarily. Because irrespective of how good you are at what you do, the person on the other end also is another chartered accountant. How much ever you improve, they also along with you improve. And therefore that also comes in as a performance gap. So that's another thing they looked at. I think there's a possibility of also of deficient performance. So there's one gap on regulations. Maybe the accounting standards and the auditing standards are not up to the mark as they should be. The other aspect is, even if those standards are improved, the people practicing may not be up to complying with those standards. Now that also creates a gap. So all of these start creating the element of expectation gap. Now, one analysis that was done as to what are the various factors that could contribute to this. One is fraud detection role. We do keep calling ourselves out saying identifying fraud is the responsibility of the board and management, not that of the auditors. So that itself causes an expectation gap, because the investors or the public, their expectation is if there is a fraud, the auditors will find it. But as we've always said, that is not our responsibility. Next, from a regulatory perspective, there is an auditing standard on fraud considerations by auditor, which means an auditor has to evaluate, consider the possibilities of fraud, where it can occur, and include it within their plan. Now, if they're doing that, the public's expectation is, why was the fraud not found by the auditors? Power of hindsight always is a benefit. But if you get down to it and look at, have you individually planned for your audits correctly? If you think back, you always feel, yeah, based on the information I had at that point of time, yes, we did plan it. On hindsight, now that you know a fraud had occurred in this place, would you have done your planning differently? Probably. You would have revised and incorporated something else additionally in your plan. But that is all from hindsight. So that itself is causing an expectation gap as to why, after an auditor has completed his work, a fraud comes out. Why couldn't the auditor have identified this fraud at the time of the audit itself? Another one is responsibility to third parties. The report, of course, is to the shareholders and the board at most. But there's also an expectation that the extent of work done and the report that is done should also be used by others, whether those are tax authorities, whether those are analysts. It should be keeping those guys in mind as well, not just shareholders and board. Assessing nature of balance sheet valuations. The models, now of course there are a lot more rules and regulation around valuation models that companies should apply, but there was a point in time where you could do a lot of valuations. There is also a lot of concerns that the people involved in valuations come out with unique interpretations, unique numbers that were otherwise never found out. You know, you have something called adjusted EBITDA that is used for valuations. EBITDA itself is a non-financial measure. Over and above that, you have an adjusted EBITDA, which is then used as a multiple for arriving at, you know, whatever valuations one does. So when people start using these for valuations, and with the way IFRS or Ind AS is drafted, a lot of reliance goes into fair valuations. And with all these models and, you know, concepts available, people can manipulate numbers they want. Now I say adjusted EBITDA at 50 multiple. Should it be 40? Should it be 50? Should it be 20? Open for a lot of interpretations. But when it comes down to an audit, the auditor is required to confirm, as he's carrying out his procedures, whether the fair value so determined is split and there is no element of bias, there is reasonability in assumptions, and that the difference, if any, between what the auditor perceives to be fair value and what the fair value management has determined is not exceeding the overall materiality that is applicable. That means the person who's conducting the audit, there is a level of expectation, has sufficient knowledge and experience or valuations. Now, how many of us would have done sufficient valuations to say, I have sufficient experience? Very few. Therefore, there then comes in saying, does the firm or the auditor have reference to sufficient experts? Again, a lot of questions get raised because there is a specific auditing standard which refers to what needs to be done when an auditor has their own expert. So compliance with those standards, they found a lot of gaps. Non-involvement of the relevant experts, again, there were a lot of gaps. So there's a high level of expectation on these as well. Another that came up was, of course, auditors' independence. Enron was one example where they were claimed that the people auditing it and the people providing the consultations on how to do a certain transactions, both were the same firm, and therefore independence was not being met. In a lot of cases, even now, the discussions that keep happening around frauds, the comment is, again, whether the auditors were fully independent or not. Again, aspects on conducting the audit, that is, one is ability to scope or cope with the amount of risk that is involved and evaluation of uncertainties. For example, you're auditing a company which has operations across the globe, but you are a firm who has significant operations only in India. Now, fine, the company may say, I'll incur the expenses. Your team can travel. You travel to the US, you travel to UK, you travel to Middle East, you travel all over the place to audit these entities. You do not know the local regulatory requirements that exist in those countries. You may know the accounting standards, you may know the auditing standards, but you do not know the laws and regulations that are applicable in those countries, and therefore are not really in a position, and there's also the compliance with NOCLAR that exists, to be able to determine if this company has complied with all they have to. Are there any adjustments, contingent liabilities that need to get recorded, disclosed in the books? Very difficult to make the assessment. And therefore, you know, how are you dealing with this element of risk? The uncertainty that exists that you could have missed something. Do you have sufficient aspects within the way you function as an audit firm to comply with all of this? Now, these are various aspects which started contributing towards the expectation gap. Now, if we look at what are the three elements, one is knowledge gap, the other one was performance gap, and the third one that is now being spoken about is evolution gap. The difference on knowledge gap, of course, is, as we discussed earlier, what the public thinks auditors should be doing and what the auditors are actually capable of doing. So since the public has no knowledge of the standards, the applications, the interpretation, it's like very recently after the Think and Learn thing came out, there was also a note that is being circulated about what one of the parliamentary members has written to the ministry, questioning on certain things. If you look at those questions, it's clear indication that person has no knowledge of accounting standards. But that's the expectation. They expect some things, they don't see it, they raise questions. Now, for a chartered accountant to try and explain that, it gets also very difficult because you have to start explaining it in layman terms, not start drawing references to accounting standards. And therefore, this gap will exist. No matter how much you explain, the public is never going to be satisfied because this is a technical matter. So that knowledge gap has to get bridged. Now, that has something that perhaps as a profession is not something that we can do. It is something that has to come from the regulators. There has to be sufficient communications, white papers, other forms of knowledge share that has to happen so that the public, whether you're talking about general public or the regulators, have a better understanding of what it is an auditor can do. And therefore, try and bridge that knowledge gap. One of the other aspects also that is being looked at is how detailed should an audit report be? Yes, we have brought in a few aspects. There is an element of key audit matter, but globally there are certain additional revisions that are coming in, which goes on to further explain how the auditor has approached the audit. In the sense, if it's a group, the audit report also covers, did I visit all the subsidiaries? Did I visit the joint ventures? Did I audit all the subsidiaries? What kind of interactions did I have with the component auditors? All of these are also now, probably going to form part of the audit report, including explaining in more detail what is the materiality that the auditor has considered, how did they go up identifying which should be the benchmark or basis, what was it that they applied from their professional knowledge that to be the reasonable materiality levels. Right now, there's only a small paragraph that comes in the current format, which is just saying that you have factored materiality and has been discussed with those charged with governance. But a far more detailed report is expected. There are certain aspects in Europe, at least, we might see it in UK, where some of the listed company audit reports, if you look at it, are 5-6 pages main body reports, where they started explaining a lot of things about what they have done as part of the audit itself. Other aspect is on performance gap, principally on between what auditors should be doing and what they're actually doing. Now, this is, of course, getting bridged by a lot of compliances. One is, as we said, the peer review, the QRB, compliance with the AQMM that's now coming up, the reviews the NFRA is doing. These are aspects to try and bridge this performance gap to get the auditors to move up from what they are doing to what they should be doing. The third one is the gap that is coming from evolution. There's always been a lot of talk on technology. From the time when I first started, we actually used to audit using physical books, those large ledgers that one would open. The final entries would always be written in pencil. That is just to get the GL to map. And once the audit is over is when those final things would all get inked and the totals would come in ink. To a time now where you have complex ERP systems like SAP, where a single transaction results in 5 or 6 different entries within the system, because there are multiple subsystems and they all post entries as they go in before the final journal entry gets updated. So a simple transaction as an advance could have 3 or 4 transactions that go in. So with the number of transactions coming in, and I also get reminded by a conversation I had with one of the CFOs about the recent recruitment that he was doing, where he was interviewing a newly qualified chartered accountant, and he had posted him a question saying, when you're calculating depreciation on asset, what journal entry would you post? And that person's response kept him totally lost. That for newly qualified chartered accountant's response was, why do you need to know that? Aren't you big enough to have an ERP system? All I need to do is press a button. So the CFO said, I agree, the answer was right. All he has to do is probably press a button, but how can I not know what the journal entry is? That guy could not answer could not give an answer to the question. He did not know what the journal entry was. Because the extent of technology that is coming in, people are forgetting the basics. And that is causing another gap. 2, for those who are very strong on their basics, technology is creating the gap because we are not comfortable with technology. Yesterday, when I was on an event, we had a stand-up comedian who was conducting jokes, and he made a statement. Of course, everybody laughed on it, but there was an element of truth, where he said the extent of level and experience of a person is inversely proportional to the extent of comfort with technology. He said, have you ever seen an instance where a CEO has walked in and made a presentation directly? He said, every time the CEO walks in, he will look around, look for the IT guy, the office boy, and say, can you set up my laptop? I want to make a presentation. All he had to do was connect the HDMI port and probably just switch it on. But half the time, the CEOs don't know how to do that. They always get somebody from IT or the local person to come and fix the laptop up to all the wires that need to be done just to make a presentation. So he said the level and experience of a person always inversely proportional to comfort with knowledge or technology. That being said, that is creating the evolution gap. Because those who are comfortable with technology, their basics are not strong. Those whose basics are strong are not comfortable with technology. And therefore, there's a lot of push there as well, saying what should, as auditors, we do as far as application, and it also comes into the AQMM, on how do we do with data analytics? What are we doing? Are you maintaining all your requirements on cloud? Now, of the time when we've kept manual files, according to AQMM, that should no longer be the case. You have to start maintaining an electronic form and maintain it on the cloud with sufficient access to everybody. So that is the requirements under technology. So that is causing another evolution gap. So these three principles of gap, whether it is knowledge, performance, or evolution, is causing what now we refer to as the expectation gap. Now to say, if you cannot meet the expectation gap, do not get into audit. It's not one or two elements that we are talking about. There are a lot of factors, and even the largest of firms cannot come and say we've bridged the gap between these three gaps. No, there will always be scope for improvements. No matter how much you do, there's always a scope for improvement, and there will always be an element of gap. Our chairman just said, some of the things on AQMM, probably the large firms may be able to comply and make do. It'll be difficult for a lot of the other firms. But if I look at the newspaper reports, it still raises questions on the large firms having complied with whatever is required. Some of them, of course, serve as the knowledge gap, because public expectations are always high compared to what an auditor can actually do. But that does not mean just because of size or availability of resources, one can escape this gap. We still have to find ways on how do we match up, improve, and try and bridge this gap rather than avoid it entirely. So now we get down to the audit quality or the model. What is the expectation? What does it consist of? One, yes, it is a capacity building measure. Now the question would come in is, when you're talking about audit quality, what does that have to do with capacity building? Isn't it not competency building? Principally, yes, it is a competency building, but there are elements with that which also kind of cover the capacity, because the requirement to comply that is coming in these various points that are there, it's not possible for somebody to comply as a single firm. A firm with 4 partners, 5 partners, it's going to be very difficult to comply. So, the policies of networking that exists under the institute, where a lot of other firms spread across the city form a network and register themselves as a network. That, I think, is going to be the next thing that has to come in, because that's the only way you'll be meeting a lot of the requirements under the model. And therefore, it is a capacity building, not just competency. And therefore, consider this as a capacity building measure is probably the right way to also go look at. And of course, it's an evaluation model. Right now, it remains as a self-evaluation. From April 23, everybody is supposed to evaluate themselves. From the notification the institute set out, they've said 2,000 CA firms fall into this. If you start grading, they also have 4 levels. Level 1 is where you're below 25% across all the 3 items. Then you've got 25 to 50%, you're level 2, 50 to 75 in level 3. Above 75, you fall into level 4. These could be the categories or levels that the AQMM model does specify. But if you start looking at this, I do expect at some point in time the regulators will come up and they will say, unless you're a level 3 or a level 4, you can't audit a listed company, or you can't audit a bank or insurance company. Now, if that happens, then no one in those 2,000 firms can ever be in level 1 and 2. Year 1, perhaps, because this is the first time they will be doing the evaluation. There'll be a lot of aspects one needs to catch up on, improve on, and therefore that is given. But everyone should look at moving at minimum to level 3, preferably into level 4. So that has to be a goal. It'll be difficult to do it in a year, because if you look at all the points that are there, it's a 5-year program at least. And it's not something that one can achieve in a year or 2. The principles also is, of course, year 1, they've said you can do a self-evaluation, see where you are. Conditions, of course, is your self-evaluation cannot be communicated to public or put on your website or on your card, nowhere. There can be no publication of your self-evaluation. If you are confident that you are actually an L3 or an L4, you can, at an interim period, request for an AQMM reviewer to come and review it and then he'll certify it, after which, of course, it will be there on the institute's website, or wait till such point in time when you come up for the peer review, which gets done once in 3 years, 4 years when they come in. At that point in time, they will audit your self-evaluation model to confirm, yes, it is fine, and then take it forward. Now, when we talk about this evaluation, whether it is by the AQMM reviewer or by the peer reviewer, we got to keep one thing in mind. End of the day, a third party evaluation is based solely on documentation, not purely on practice. Which means similar to how as auditors, we go in and audit the internal financial controls in a company. Just because the CEO said, yeah, I review everything, you don't say controls are good. You are required to look for documentation. You are required to look for evidences which support the conclusion that yes, these controls are in fact being exercised and not just documented as a control. So similarly, the same conditions will apply here, which means if you say I do certain practices, the elements of those practices should somewhere be documented. And that is what comes up in the AQMM. The extent of documentation requirements that exist are tremendous. And therefore, whenever we talk to various company CFOs, they keep talking about how every year the cost of compliance is only increasing. Now, similarly, they start impacting the auditors as well. Cost of compliance will start coming in. It's not going to be simply payroll cost. There's a lot of other costs that will start coming in, and ensuring you comply with the AQMM model is not going to be easy. So the model looks at from 3 aspects. Of course, as we mentioned earlier, one, it is mandatory from April 23. Fortunately, I don't think anyone is expecting that people will comply from day one. It is going to be a periodic affair. Even when the AQMM reviewer comes in or the peer reviewer comes in, it's hopefully the evaluations or certification is going to be similar to our IFC report as of a date and not necessarily through the year. And therefore, if you call them in March 24, hopefully the evaluation is that as of March 24, you're meeting these points to this level, and not necessarily from 1st April 23 till March 24, you've complied. Otherwise, failure rates are going to be very high. And most of the firms will probably fall under L1 because this is going to be a periodic exercise. The scoring is looked at from 3 aspects. 2 of them are referred to under practice management. One is operations, which has the highest score of 280 points. Other one is on human resource, second highest points of 240 points. And the last one is strategic and functional, which is about 80 points. So the total points that a firm can get is about 600 points, which is the maximum. For you to be within L4, it has to be roughly about 450, between 453 and 600 points. That will give you that. And the condition, of course, here is you have to satisfy more than 75% in each category. So you have to be at 211 minimum for practice management, 181 minimum for human resource, and 61 minimum for strategic and functional, if you have to be an L4. So it can't be that you are close to 280 in practice management operations, but below 180 in human resource and below 61 in practice management and functional. That can't be the case. Then you'll fall into L3. So meeting all these minimums in all the 3 categories becomes crucial for you to get the necessary gradings. Right now, this is mandated only by the institute. But once this gets into play, probably in a year or 2, I would anticipate that the MCA will also take interest and the NFRA may mandate compliance of this and may put it under their review also. That when they are looking at the auditors for listed companies, they will also go and see compliance with these models. There could be conditions they will come up with saying, only L3 and L4s can audit, the others can't. And as this becomes more and more focused, and if this comes into the Companies Act, at some point in time, it could also apply to those doing private company audits. Right now, there is, of course, talks that certain private companies will get exempted from audit altogether. Of course, there's a lobby to say no, but it is an anticipated future. That certain elements of private companies which are not considered to be consequential or impactful will be exempted from need of audits. And it will be based purely on management's accounts. And only those which have a certain exposure, could be to extent of bank loans taken over a certain limit, the private company, or revenues over a certain number, similar to how the IFC exemption is, will be requiring an audit, and those not meeting those are exempted. Once those conditions come in, these AQMM compliances may also extend to auditors of those private companies. Of course, not something that's expected in the next few years, but if I look at from a 5-year horizon, 10-year horizons, these will start becoming mandatory to all auditors. So those who are not necessarily auditing listed entities may look at it as something in their 5-year plan, saying at some point in time, I need to start getting these into my organization. Those who are doing listed entities will probably have to do it a lot sooner. Because once this becomes public in the peer review certification, which is the minimum gap you will have is if you just finished it now, you have 3 years before somebody comes and looks at it. And by then, these will become public in your peer review certificate as to whether you're L1, L2, L3, or L4. So once that comes out, of course, with the extent of restrictions that are there or responsibilities that is there on independent directors, there's a very good chance that even if the NFRA or the MCA does not come up with regulations, the independent directors would prefer an L3 or an L4 as an auditor because they have far more responsibilities. So either way, it's only a 3-year bucket that we'll probably have within which to move within L3 or L4. You cannot afford to be below that. Now, what is this practice management operations, which has the maximum points? This is further split into 9 subcategories with scores given to each of them. One is on the practice areas of the firm, sufficiency of workflows and manuals, quality review, that is SQC1 compliances, monitoring of efforts. Now, effort monitoring is partially covered here, partially goes into the human resource element as well. Quality control for all engagements. One is, of course, from an overall manual. The other one is on engagement specific. Benchmarking of service, that is getting feedback from clients, understanding what's the level of service you're providing, client sensitization, technology adoption, and the overall revenue budgeting and pricing, which is going to be interesting because one of the things that we faced when audit rotation came in was price cuts. It was very clear cases where there was an undercurrent where everybody was clear that unless I cut my fee, the management is not even going to look at me. And therefore, suddenly we saw, from the transitions that happened between 2016, 17, 18, if you look at the audit fees, you can see the sudden dip in the fees that was happening because there was a lot of price cuts that happened. Now, there is a requirement here under AQMM that there is sufficient review that's happening on your revenue budgeting and pricing. Now, if you go point by point on the practice areas of the firm, now applicability itself, and one of the things that as we start reading this, one other thing that CAs are very famous for is finding the loophole within the act such that they never break the law, but take the benefits of the loophole. So now here, if you look at it, it says from a practice area, compliance wise, audit revenues should represent minimum 50% of total firm revenues. And if you do that, you get 5 points. The total here is 12. So you can get 5 points. If you're above 75%, you can get 8 points. You should have a vision and mission statement as an organization with forward-looking practice statements, including how you're implementing this. That gives you another 4 points. Now, to be honest, when you walk into most of the firms, I have never seen a vision mission statement being put up there. You see that in companies, but very rarely in audit firms. Now, just having a vision mission statement itself is 4 points. So you really now start thinking, what is it that we want to achieve? And the next they've gone ahead and added, including implementation, which means you just can't have a vision which other than the person who stuck that on the board, nobody else knows what it is. So everybody should be aware of what that vision of the firm is, and there should be sufficient communication and efforts to fulfill that vision. So implementation also is required. So when somebody says, audit revenues have to be 50% of total. Now, what I've again observed, a lot of people are partners in multiple firms. So does that mean I have one firm which does only audit, another firm which does tax services, another privately limited company which does accounting services? So I'm director in one, partner in two. Nothing which says I have to be a full-time partner only in one firm. So does that mean the firm which does only audits, now 100% revenue is only audit revenue? Because my accounting services is done from the private limited company, tax service is done by another firm. So principally I'm complying, but I don't think that necessarily is the intention here. But again, partner is there, his senior is there, who's either a paid assistant, that is a qualified accountant, or somebody who's finished his articleship, writing his final, and you have the article assistants. You sit in the room, the partner explains what he wants done, he gives his experience of the client, he explains everything. All of the teams listen, they go back, they implement, they prepare a summary of what they've done, and they show the final summary to the partner. So what goes into the file is the work that they've done, the final summary that they've prepared. Now, if somebody comes and says, I want to see what planning you did, that was principally just the team sitting together and talking. Nobody's really put down anything. So that was found as shortcomings. So now this manual is supposed to cover saying, these are the auditing standards requirement. How will you ensure compliance and what documentation will get maintained? Which means for each aspect of the auditing standard, there should be the comparable documentation requirements of compliance. Again, this goes very similar to your controls. I may have 100 controls that are put in. The question would be, how do I demonstrate these controls are actually being exercised? So there would be a manual, which could be a accounting SOP, process SOP, as to what will be done, what will be maintained, what sign-offs will be maintained where, what work papers will be maintained to demonstrate that the review was actually done. So similarly, all of these has to come in, which also counters the next point, which again, and these are simple yes, no questions. Huh? Either you have it or you don't. If you don't, it is 0 points. If you have everything, it is 8 points. So there are only two requirements. One is the manual. The other one is whatever is required to support the manual, which is standard formats. Which means as a firm, you should have a standard format on engagement letter, management rep letter, significant work papers, the format of audit report that as an organization you will issue, and what is the process you have in place to ensure that all the teams are implementing them. So this gives you another 8 points. So again, it is simple yes or no. Do I have the necessary standards? And two, do I have a process to ensure implementation? It is again like saying adequacy and operating effectiveness of internal controls. So you can't just have adequacy with all the policies and formats, but implementation is also required. And since this is a yes or no to both, so if I have the policy, but I failed in implementing, answer is no, 0 points. So it has to be both to get the full 8 points or a yes response. So again, aspects that cover when I look into, what are you talking about a manual covering What should the audit manual have as ensuring compliance with standards? The guidance that is there also further goes down saying not just on planning and risk assessment, also on your communications to those charged with governance. If I again look at SA 700 on an audit report format, there is a paragraph which says that yes, I have communicated with those charged with governance. I have communicated to them all the important elements of the audit. I have communicated to them the materiality on the audit. Now, 700 is silent on what are the material elements of an audit. You just require to confirm that you communicated with those charged with governance. Your audit manual should specify how does your team decide and what is relevant, important, what are the items of communication to those charged with governance, when should you communicate, when should you not, what need not go to those charged with governance, what can go only to management. Now, as an example, it could come as from your controls evaluation. When I'm looking at IFC and you look at the institute's guidance, there are three elements. One is deficiency, significant deficiency, material weakness. Clearly, communication requirements there says if it's a deficiency, you can communicate to management. Significant deficiency, you have to communicate to those charged with governance, which means audit committee or board. Material weakness, not only communicating to those charged with governance, it will also impact your audit report because you have to qualify. So these are the three elements there, and therefore the guidance of IFC clearly specified what and how you should communicate. Similarly, the audit manual should cover all aspects of the audit. What are the elements that a communication to those charged with governance should cover? Audit procedures and work paper formats, principally you cannot be standardized too much because industry specific it changes, especially if you're trying to cover a standard work paper for revenue. Very difficult because revenue recognition requirements change industry to industry and therefore your testing has to change. So a firm may need to see if I'm going to standardize the work paper format, I'll probably have to standardize it industry wise and not area wise. But for example, when I'm testing, say, receivables, I may standardize it across industries or a clump of industries at least. So again, those need to be looked at. Requirement again is to have a repository within the audit manual of all standard audit procedures. So you should have a repository. Of course, the teams may add additional procedures which are very engagement specific, but you should have a standard list of procedures which at the minimum every team has to do. Key aspect here, again, what I'd like to bring here is, implementation has to be demonstrated. Just having policies, processes, work paper formats, elements of having shared and communicated this with staff is not sufficient. And therefore, there has to be element of testing. And therefore, I've given a reference again. It goes into your quality control when we are talking about, because there you have to keep validating your engagement files to make sure all of these manuals and practices are being complied. So this is kind of linked. So what happens is you cannot have a yes in this with a no in 1.3. When we get to 1.3, I will show that. Because there's a kind of interlinked. So if you get yes here, you'll have to get a yes there. If you get a no there, this also automatically becomes a no. So you have a risk of losing points on both elements if even one of them gets into a no. Because 1.3 is talking about quality and there are 24 points here. So this ensures implementation of what was covered in 1.2. And therefore, if this becomes a no, you have not complied. And all of these are just simple yes, no. So there's no element of judgment here. Either you have or you have not. There is no gray area. It's all pure black and white. So when you're looking at this also talks about having detailed formats, checklists, under what circumstances and conditions would you accept an audit? Do you have a client and engagement acceptance process? What are the various factors as an organization should you look at before you say, I will do the audit? It cannot be purely the fee. It can't be purely the name of the company. Yeah, it's a big name. Fees is 50 lakhs. How can I say no? That's probably my largest engagement. But that can't be the basis. So there are various factors where as an auditor, you have to factor this in. Are these reasonable? Conceptually, yes. And why? Because that was also evidenced during 2017 and 18, when there was a string of resignations of auditors. Okay, because why? Because in 17 is when rotation principally was mandatorily applied after the 3 years gratifier period that was available. New auditors came in, positions changed, understandings changed. They were not comfortable to sign what was previously existing. Everybody started resigning. Where actually there had to be a guidance that subsequently came out along with MCA and ICA saying, if you have signed off Q2 and Q3, you cannot resign without signing off year end. Otherwise, they were concerned saying, you come to the year end, all auditors were resigning because during limited reviews, you might not find much problems. But once you start the audit, you may find a lot of things you're not comfortable with. And the position taken was, no, you cannot. Once you get past Q3, you cannot resign. So that had to come in, saying, give a disclaimer, give a qualified, do whatever you want. Put that in your report, issue the report, and only then exit. So that had to come in, which means the requirement here saying you should have sufficient client acceptance formalities is what was missing at that time. Why? Because firms were losing clients, they had to replace them. Whichever came in was accepted, but these now have to be complied. Evaluation of independence. Of course, all of us would ensure we were independent while doing it. Requirement here is not just the partner. The partner is responsible to ensure independence of all his stuff. Again, if I go back to how it looks at from the Companies Act definition, which means not just the staff member's spouse, parents, brothers, sisters, nobody can have any interest in that company you are auditing. And therefore you should have, again, these are not just concepts, implementation necessary, which means when the peer reviewer comes, you should be able to show documentation to that reviewer to say, this is how I have ensured that none of my staff members were not independent. There is independence confirmation. This is how they have come back and confirmed that nobody in their family has any interest. So the process should be there, implementations should be there. Okay, the rest we already discussed, checklists, formats, documentation, work paper related, what should be there. The additional thing that's come up here is not just on acceptance. Another policy you should also have is at what point, under what circumstances will you withdraw from an audit, resign from an audit before your 5-year period is over. So that also should be a policy. And all of this is what you should be complying and implementing. So again, these being under quality, if any of these becomes a no, and these are various factors, you have to comply with all of them to be a yes. If you're not complying with some of them, it is a clear-cut no. So it's not that I have a client acceptance checklist, but I do not have standard formats of business understanding. You have to comply with all of them. These standard formats get linked to what we discussed in the previous one, where we're talking about standard formats across all aspects. So total, you lose up 40 points if you do not comply with this. Effort monitoring. Again, most of this is, how have I planned for an engagement? How many people do I need? How many hours do I need? What levels will be complying? Have you done the budget? Do you have the budget in the file? Have you monitored the actuals against it? If you've got the deviations, how have you anticipated or examined those deviations? If the deviations are because of client, have you gone back and looked at whether the fees that you are charging is appropriate or no? So these all become factors to look at. Key thing here again is a yes or no question. Deployment of technology for monitoring the efforts and project management, which means the previous, and I still remember during articleship days, we used to have a huge sheet that we used to submit on a weekly basis, which had 7 days on it, and we would put which engagements and how many hours we worked and make sure the total came in. Now, had we proceeded with that, we probably would have got a 0, but we moved on to an electronic form of timesheet monitoring. Now that will become mandatory. So not just having a system of timesheet, but it has to be technology supported timesheet monitoring. Because if it is not, 0 points. If you have a technology supporting the monitoring, 8 points. So a lot of the aspects that go into the AQMM is, all yes and no sort of a item. So if it's yes, you get your points. If it's no, it's 0. And therefore one has to be very careful. There's partial achievement will not do. Either you've done complete or you've not done. So this becomes very judgment. It can't be like, I have done partially, so can I get half the points? That option is not there. Because the points are either 0 or full. Now, one aspect where they're giving you some leeway here is when you're analyzing budgets versus actual efforts from both cost and fee. As to should I go and request for a fee increase or no? Have my cost overshot my budget or no? If you do evaluations on engagements, and here when you're looking at a firm level. So if I have 30 clients that I'm auditing, I've done this assessment on 2. So 2 out of 30, if I look at it, it's less than 10%, I don't get any points. So the extent of engagements in which, and when I'm talking about is not you having done it in the mind, there should be documentation in the engagement file saying that you have examined the actual time spent. How have you compiled the actual time spent, compared it with the budget, evaluated the reasons for deviation, all of that should be in your audit file. And depending on how many audit files have them, you check on compliance and see based on the percentage of compliance, they give you points. So if it's available for more than 90% of your files, then only you get the full points of 20. So again, the extent of documentation, this is all pure compliance now. It's yes, no everywhere. It is mandatory that you not just put these policies, clear cut. And this is not just an evaluation. You can't have a case where I budgeted this audit will get done in 300 hours. I spent 750 hours. I put it. No. There will be questions saying, were you aware that it would take 750 hours? What caused the movement from 300 to 750? Because if your audit report is still clean, then was there something wrong in the audit? Why did you take additional hours on this? Was your budget wrong, or was something done for you to give a clean report? So that also needs to be careful. We should also be seen, and we'll probably get that when you're talking to HR, human resource elements also. It can't be the case that, you try and meet the budget of 300 hours, and therefore you have a demonstration where it looks as though your staff is sitting idle for most of the time, because the time they're spending on the engagement, they're not recording it in. That also is a risk that cannot happen. So another element is quality control. This has an 80 points coming into it. Again, purely to be read with yes or no. Do you have a policy compliance with SQC1? So if it's yes, you get your points. If it's no, 0 points. Again, do you have an internal process of complying with engagement quality reviews? That is always another partner who's reviewing the file before you sign your audit report. It has to be a practicing chartered accountant is reviewing it. If not a partner in your firm, you should have a network with another firm to have those people look at your file before you sign off the audit report. Now, how many engagements are being done? And how many of them have findings, don't have findings? Both of these get assessed. Now, internally, if you're doing it for, again, you've got percentages, depending on how many files are getting quality reviewed against total number of files that you have, your points come in. Similarly, when ICA does its examination of your files, whether in the form of peer review or if a review happens from QRB or any other form when they come in for these validations, if they find observations in your file, there again you'll have a problem. If there are nil findings, then number of files that are reviewed, and to remember, with the numerator being number of files with findings, you work out a percentage. So if it is nil, then you get full points. Otherwise, as a percentage, your points again start changing. So more than 95% of your files do not have observations, you get full points. Otherwise, you get lesser points. Again, these are policies, and in addition to policies, of course, implementation, ensuring compliance with code of ethics that the institute has. How are you monitoring it? The leadership roles. And when you say leadership roles, it would be the way this whole thing structures. Sometimes that they get the feeling the way the whole thing will get set up, you'll probably have somebody known as the managing partner who's holding senior leadership role. Then you'll have all the other partners, and then they use the word manager. So you'll have to have managers and then staff. So that has to be a triangular organic structure in most of the firms in order to start complying with the human resource aspect that comes in. And those also come in here because you'll have to have policies on how does all these levels comply with the ethics, and how much role does leadership play to ensure that these policies are in place and being followed by all the partners in the firm. Then again, what comes in, and this is a little surprising as to why it's sitting under quality and not under practice manuals. They're looking at having accounting and audit resources, Q&As, thought leadership that is coming from within the firm that are being published and available on a shared network that is accessible to all the people in the firm. So experiences that senior leadership or senior partners might have, having audited over these many years, those should come in as Q&As. And how under those and this is similar to how probably we'll have from our expert committees from the institute that would have come up on how certain applications will get done. So these should come in addition within the firm and should be made available. Again, yes or no? Do you have all this compiled and made available? Yes, you get your points. No, you don't get the points. Now within quality, also there's, when you spoke earlier about effort monitoring, there's one element again which goes for 12 points. Has time been spent on business understanding, planning, and risk assessment? Which means within timesheet monitoring, you will have to split the time capture that you're having with regard to how much time was spent on business understanding, how much time got spent on risk identification and mitigation planning, how much time spent on execution, how much time spent on reporting and concluding. So your timesheet monitoring system should capture at these different levels. The way this is structured, these are all getting interlinked. SQC policy will get linked with para 1.3 when you talked about EQCR. The evaluation of adequacy of resources goes into effort monitoring at 1.4. Your documentation and time spent for quality review is also linked with 1.2, 1.3, and 1.4 we spoke earlier, which means a no in any one of them will result in the no in the others also. So if you're looking at achieving at least above 50%, close to 75 or above 75%, you cannot afford to have a no in any of these categories, because the way they are, it's all interlinked to each other. They're not entirely independent where I can say no in 1.2, but I got yes in 1.3, or no in 1.4 and yes in 1, not possible. They all have an interlinking. And therefore a no in one will automatically result in possible no in the other. This is similar to, when we do in an audit, it's like, I've done my control testing. I'm saying controls are good. But when we are doing a substantive work, we picked up sample for testing and we found errors in those samples. You can't say my controls are good. I'll just fix these errors. You are required to go back and reevaluate. Can I say my controls are good? Similarly here, you can't say I've completed evaluating 1.2, score given, closed. Now let me go into 1.3. No. So we have to be careful, because the totaling of these points, just 1.2, 3, and 4, 5 will give you more than 50% of your points are covered here. So you can't afford to have a no in any of them. Next comes on benchmarking. Now, these are some areas here where you got 0 or negative markings. Most of the other cases was 0 and positive markings. Here you have a few cases which gives you negative. I'm not too worried about this, because this is talking about if you've done compliance with the rest, these really shouldn't come up. First one, of course, is just follow standard delivery methodology, which means you have something like a record management system, which says, I printed 3 audit reports. 1 was maintained in our file, 2 was handed over to client. So there's a standard delivery. What do I give in hard copies? What do I give in electronic copies? Especially the last 2 years, a lot of things were done to digital signature. Now, principally, if you've signed off something digitally, you cannot be signing the same thing manually. So what is digital is final, which means now, how do I track this? Does this go by email? Does this go, how do I send it out? It has to go by email, because that's the only way the digital signature is valid, can be validated. I print it out, it cannot be validated. So what items will be delivered in what manner? You should have a clear methodology and policy. That will give you 4 points. Other than that, the rest is all negative scoring only on errors that may be there. Basically, you've given your report out, but you have to go back and redo your audit because the report was wrong. Then those end up giving you negative points. Another factor on service delivery benchmarking, and this was interesting, was timing of audit interactions with management so that it integrates well with the requirement and timelines. And they've only said this excludes client side delays. So to ensure the audit, so requirement here, if I look at it, A, there should be in sufficient time a plan made. The plan that is being made by the auditor cannot be derived or put in place without involving the client or the company, which means you should have had meetings with the company at a certain period of time, which gives you sufficient time to understand what's happened in the company, sufficient time to factor that in your plan, prepare your budgets, because effort monitoring requires you to do that budget based on what you expect to take on the engagement. They also require you to monitor the time spent in business understanding, time spent on risk identification and mitigation. So all of this is supposed to happen initially before you actually develop your detailed plan. So the time spent should be done at a reasonable time to ensure you can carry out what is necessary within a reasonable time. Again, here you can't say I've done this if you find instances where the audit has significantly surpassed your budget. Unless, of course, you can document the client side delays, which means I budgeted 300 hours, I took 600 hours. I should have documentation in the file, which can easily state why the additional 300 hours came in. And if that can be said is because of client side delays, then you are safe. If not, it's difficult to get to say yes here, because then principally you did not have your discussion with client, giving you sufficient time to plan your work, which is why you took extra time. Chances are I was starting it on Monday. I met the client today. Now, does that mean the next 2 days is sufficient for me to plan? It may not be. So if I wanted to start the work on Monday, principally I should have gone and met him in August, which gives me sufficient time to question, understand, identify risks, have the planning, plan out my audit work, give the company sufficient time to prepare for my people to come in for audit. So it cannot be a case that I did it 3 days before I started. It may not necessarily be 2 months before I start either, but it has to be sufficient time and it should be demonstrated. Again, therefore, which means when the peer reviewer comes, you should have sufficient documentation to show when did you go meet, what was discussed, how did you prepare your effort monitoring post that, which means this again gets linked to the earlier section. And that is what I found interesting when I went through all of this, how though there's separate different 9 subcategories, they are so interwoven with each other. You either comply with everything or you don't comply. There's no 50-50, except for the question which talks about how much of your revenues is audit revenues. That is on a standalone aspect. Other than that, everything is all kind of interwoven with each other. Now, from client sensitization, if there are revisions that are happening in regulations, standards, your experience in the similar industry, one of the expectations here is, have you gone and spoken to the companies saying there is this change in Schedule 3 that has happened? How will this affect you? There are new indices that has come up on interest rate benchmarking. How will this affect you? So have these sensitizations, awareness discussions have happened with the company. So you're supposed to have this, which means as against the past practice where you probably just met with your clients or your clients dropped into your office and you would spend some time talking to them on what's happening, impacting. If the peer reviewer or the AQMM reviewer has to confirm that this is being done, now you have to maintain minutes of these meetings. And these minutes have to go into your audit file. Therefore, when the reviewer comes in, there is documentation support saying, yes, I did do this meeting. I did have this discussion. This sensitization did happen. These are the minutes. Next one is on technology adoption. And there is 64 points out of 280 points that is given in this. Now, adoption and the way it is stretched out, 4 points for a yes or no question. And the yes and no is covering various aspects. So you should be addressing all of them to get a yes. Which means now you have a process for internal chat Now you have to invest in a Skype, or you have to invest in Microsoft Teams. Of course, fortunately, a lot of firms had to do it mandatorily because of COVID, but now this is a policy. So you should have invested in an internal chat system, which can maintain or encrypt or keep the data of chat that is there confidential. So you cannot be using WhatsApp for this. Though of course, WhatsApp also provides encryption and option to delete once within a certain period of time. But the intention is you should not be using this, but it has to be an internal chat communication. An automated attendance and leave system, which again we spoke earlier, that it has to be technology based. So again, under effort monitoring, also it talks about technology based time monitoring. The same thing comes here, that it has to be technology based automated attendance and leave system. Project and timesheet management, that also has to be technology based. Digital storage of records, which means even if it is a physical document, one of the requirements on AQMM is you take a scanned copy of it and you have a digital record of it. So that even if the physical records are lost, burnt, destroyed, the digital record is still maintained. All of this should be on a centralized server or cloud. It cannot be on individual systems of the partner or the staff. Two, there has to be a digital library of all the information being maintained. Of course, the option they've given is either you can have your own or you can subscribe to the ICAI's library and have used that for reference. You should have client interactions. A lot of firms have publications they release. Each time there's a new change in regulation, as a sensitization, there's a small publication that goes out or an alert that goes out. So these alerts, updates now should be made available on the website or circulated. Licensed operating systems, which mean pirated versions of Windows or Tally, can no longer are permitted. It has to be a licensed version. You should have your own email domain, which means use of Gmails are no longer permitted. You'll have to start creating your own domain as well. Antivirus, malware protection tools, data security, cyber security. So you should have technology adoption covering all these aspects. Awareness of technology for service delivery. And you said technology, that means A, you probably have to have a technology-based audit tool, which captures all your work papers and you maintained it, and use of analytical tools, basically what is known as CAAT, computer-aided analytical tools for audit. So all of these again is yes or no. So either you're doing, not doing. Next one was on revenue, budgeting, and pricing. Again, these are again yes or no. Looking at whether you have client-wise revenues, you're analyzing it, you're ensuring you're complying with code of ethics that no single client exceeds 40% of revenues. The fees and scope is based on your efforts monitoring and you're ensuring quality is being maintained. You do not discount quality to meet the low fees. So these are all again should be demonstrated. Now, before we get into human resource, we'll take a 5 minutes, 10 minutes break. Okay, moving on to the next element that is there after performance management. This is the second largest segment, 240 points on human resource. Significantly, this is again linked to what we spoke earlier, but not so much on effort planning, but resource planning and monitoring. Resource planning significantly covers how have, as a firm, decided A, how many employees it should have, how many of those employees should be practicing, or rather people with the CA degree, how many should be articles. If everybody maintains an organization in a triangular form, what should be the size of that triangle? And how do you plan and monitor whether that's being complied? Another one is on training and development. The requirement here is not just compliance with the necessary CPE credits that all of us need to get. Over and above that, what is the training plan that is available, the amount of time being spent, resource turnover, compensation management. Of course, that's 104 points. Meaning what policies and practices a firm has to ensure A, that the compensation being paid to your staff is appropriate. Two, how are you providing them necessary time off or leave for relaxation and recuperation? And how do you monitor all of this and ensure that you keep the attrition at minimum? Next one is on qualification skill sets of employees and use of experts. We discussed earlier when you're talking about the expectation gap that exists. There are needs for IT systems, if especially we're doing bank and insurance companies. There is no way you can do that without a DISA, CISA, whatever qualifications you put in on doing IT systems audit. So just being a CA is not sufficient. Similarly, when you're doing all valuations in banks of assets, you need a fair valuation specialist, especially when it gets into derivatives, whether it's companies or banks or insurance agencies. Insurance audits, though we do not take responsibility, you will still be responsible and make sure. Therefore, you may need actuaries as well when you're looking at whether that's been done correctly, either on your roles or you're in association with identified experts. Last one, of course, is performance evaluations, which means clear-cut KPIs have been set. There is a monitoring review meeting with your employees. Feedback is being provided. Proper evaluation is being done. Increments and bonuses are being given according to the evaluations. So all of this, again, policy and implementation. Now, resource planning, one is other than the overall organization level, finding out for each engagement. Do I need a trained team? Do I need a new team that's coming in? Should there be a mix? What should be the mix? How many articles, how many paid assistants should constitute the engagement team on size of the audit? All of that should be part of your resource planning. Planning, again, should be documented, maintained in the file. Tools used for allocation, again, it could be Excel sheet. Fortunately, here they've not gone and said technology, go and implement something. So you can use an Excel sheet as well. Tracking of employee activity and productivity. Again, this gets linked to the previous one where we talk about effort monitoring, which means timesheets are being maintained. You have to ensure, and that's why I said in the previous slide when we were talking, you can't have a case that to ensure that your budgeting is okay, you get your team to book time only to that extent and the rest is booked as not on any engagement. Because when you start looking at tracking the employees' activity and productivity, they will come as non-productive. Because in a whole period of where they have 1,000, 2,000 hours, they have effectively worked for 1,000, the balance 1,000 they were idle, which means productivity is only 50%. And why is the balance idle? Because they're actually working, but to show that your effort monitoring and budgeting was good, time sheets were not booked. But then that gets hit you here. So somewhere or the other, these are all kind of interlinked. So you'll have to be careful that you do not try and play around with the time booking to kind of meet one agenda because you'll get stuck with the other one. Minimum ratios of partner to manager, manager to articles. Again, that's a policy. It should be very clear cut on how many managers will be associated with a partner, how many staff will be associated with the manager, and therefore how the organizational triangle will be formed. And you are also monitoring the overall utilizations, realizations, what is it per employee, what is your cost, what's the revenue earning capacity, and you're monitoring it to ensure you meet a certain average. All of this, again, your resource plan, everything should be documented and filed within the respective engagement files. It could not be something that gets done at an organization level and is not there in the individual audit files. Again, this aspects here, what we need to consider, that means as an organization, a good, strong, robust MIS system on talent is crucial, where you get summaries of how time is getting booked, how idle time is getting monitored, how fast you are able to respond to reduce it, because at the year end, as part or after 3 years at the peer review, wherever they come in and look at this, you cannot have a case where there's too much of idle time sitting. Employee training and development. Now, if you look at it, there are two elements again, and the points get varied and how the points get done. Now, there are 3 levels, because in the earlier slide we spoke, there has to be a triangle of the partner, the manager, and staff. So they've split them into junior level, mid level, and partner. Now, there is minimum number of hours at each level they need to spend on training. And you have 2 types, general and special. General training is when you're talking about overall on auditing standards, accounting standards, changes in regulations. Specialized training could be, how do I audit or test or validate, let's say, my evaluation of mines in the mining industry? That is specialized training. How do I, account or test biological assets when I'm doing an audit of a coffee estate or tea estate? That is specialized training. So you have general and you have special. So general training gets 2 points, special training gets 6 points. So there are three aspects here. One, you have to meet the hours requirement, you have to meet the general training requirement and the special training requirement. So just the CPE classes may not be sufficient. So if you have an audit person there, him attending CPE training for 4 hours on transfer pricing may not, will probably meet just the general category. It's not special training. So you'll also have to see which CPE sessions of the institute are they attending. If those are not sufficient, at the firm level, have you conducted internal training sufficiently to address the gap that is required on knowledge? Training should also be held for all employees to make sure they equip with technological skill sets. That is what the AQMM currently covers is artificial intelligence, blockchain, data analytics. And these should be sponsored by the firm. And implementation is also necessary, which means I can't have a case where all my staff have been trained on data analytics, but in the audit file, there is no analytics at all. So not only should I train them, they should demonstrate that all these learnings have been implemented on the audits they worked on post training. Fortunately, the application in the AQMM currently is restricted to in-scope engagements, which means listed entities, banks, and insurance companies, excluding where you are the branch auditors. So if you don't apply data analytics on your private companies, currently it is fine, but you have to apply it for your listed and banks. Resource turnover and compensation. Now, if you look at the table, when you're talking about having sufficient staff, I can get a total of 20 points, but the 20 points is split into different categories. Per partner, if there are 3 CAs only per partner, you get only 4 points. If you have 4 to 5 CAs per partner, you get 8 points, which means a firm with 3 partners should have minimum 12 chartered accountants working under it to get 8 points. If you have 6 to 7, you get 12 points. If you have 8 to 9, 16 points, 10 and above, 20 points. And this you're talking about qualified professionals. So these are not article students. These are qualified chartered accountants. And this is per partner. So the more partners you have, the wider the bottom has to be as far as the professionals are concerned. Now, when you talk about professionals, this covers both managers and qualified staff, excluding article assistants. So this also demonstrates when I talked about earlier that why the AQMM can also be considered not just competency, but a capacity building. So in order to meet these guidelines, capacity has to grow. You cannot remain a small firm, mid-size. The growth has to come in. One of the aspects will probably come in the way is it need not be a single firm. The institute already has policies in place for networking. So if you become a network with common policies, common applications, common technology, then you may start looking at it that way. So there could be more CAs in, let's say, the Bombay firm. There could be less CAs in the Bangalore firm, more in the Chennai firm. So because it's a network, you might look at the overall average and say, I'm meeting this. So irrespective of where the partners are sitting. So that way also is something you can look at, but then networking has to get applied. Rest of it is mostly HR, and the way some of these things are, a firm probably has to have one person dedicated for human resource. Evaluation of team compositions, looking at monitoring employee turnover, identifying measures to minimize attrition, service period of the professional with the firm, and the people start leaving. Are they leaving within 6 months in the firm? Are they leaving within 1 year in the firm? If it is, why is it? Is the experience not good? Are they leaving after 5 years? What is it causing them to leave? All these things are required, which means inclusion of concept of exit interviews. So this data has to be captured, has to be analyzed, and action plans have to be drafted by the firm saying, what are we going to change to reduce the attrition? Of course, the other one is on statutory contributions, making sure PF, health insurance, benefits are being given not just to partners, but to all staff. And evaluating turnover. They've also said when you're looking at what has caused turnover, look at it not just overall firm level. See if people of a specific engagement are the ones leaving more consistently, which means there are a problem with that specific partner, that specific manager, or that specific client, which is causing a higher attrition. So it cannot just be overall attrition review. It has to get down to engagement level attrition also. And again, all of these are yes, no questions. So either you are doing it or you're not doing it, which means documentation supporting all of this should be in place. Our overall framework for progress and compensation based on performance, which means you should have different performance levels, like meeting expectations, not meeting expectations, exceeding expectations. You can put 10 levels, 5 levels, whatever seems appropriate, but there should be a policy saying at each level, how will the compensation differ? Which means based on performance, there could be differing payouts that happen to different employees. Access and use of technology infrastructure for better day-to-day work. These have probably come in more from a COVID's experience because your policy should permit remote working, which means where necessary, whether have you applied for VPN connectivity so that access, because they've said trusted source should be maintained, your own system or server, cloud. When all of this come in, VPN becomes crucial. So you've invested whether those technologies are made available. People may not be working from remote, they may all be working from office, but you should have the facilities which permit them to do remote working. Coaching and mentoring programs, especially for women employees, process to enhance diversity. Now, diversity and inclusion also falls into one of your criteria here now, to ensure that there is a diverse group of people, both at staff level as well as they're brought in here to say leaders, which means even in the partner level, there should be an element of diversity. Right now, of course, the example given is more gender diversity. They've not gotten into cultural diversity, but all of those aspects need to be coming in because this would be a policy. Policies providing staff time to rejuvenate, especially after busy audit seasons. Now, bottom it will also come in. These are not just policies, implementation also is required. And therefore, you should be having, how do you ensure that if there's an engagement where staff has been working late consistently, how do you give them off, not put them onto the next engagement, but give them time to recuperate and come back. Mechanisms to listen to people, take views, suggestions, those have to be set up. There should be specific standards on recruitment, which means there should be an assessment. Just because he's a chartered accountant and he's applied at the firm, you should not take him. So there should be a clear-cut interview process, evaluation process as to whether, based on the interview, has he met certain criteria, which means you have to have a policy with established criteria, which will also require saying this minimum criteria need to be met before I can take the person in. And those have to be followed, which means for each interview taken, there has to be a checklist that is filled up, comments of the interviewer put in, filed. Again, employees are compensated as per a defined approach, salaries mapped to knowledge and experience levels. So all of these come in. So again, policy and implementation, which means if I take a new chartered accountant or recruiter who has got 5 years experience, how do I compensate him? He cannot come as the fresher. It has to be somebody giving cognizance of his experience. But if his experience is not in what I need, then how have I factored that in compensation? Again, all of this needs to be documented in the employee file, mostly by the HR person if you have an HR person, but that should get documented and maintained. Qualification skill sets, again, inclusion of professionally qualified members in the firm. This is done significantly where firms are involved in statutory and tax audit services. So whether total number of professionals, whether it's less than 30%, then 4 points, which means you have significantly staffed with articled assistants. And therefore, number of CAs to total number of people, which includes article assistants. If the number of CAs is less than 30%, you get only 4 points. If it's more than 50%, you get full 12 points. So again, that ratio, it cannot be such that your triangle consists mostly of article assistants. And most of the CAs are already partners. That can't also work out. So you'll have to maintain the reasonable category. Also, whether you're staffing, you have factored in and maintained sufficient people with necessary qualifications depending on the client portfolio. So if you're doing banks and insurance companies, you will need to have people with CISA, DISA, valuation experience, people with actuarial experience. Are they also on your roles as employees? If not, you should only have partnering terms or networking terms with those specialists. Because if you look at the auditing standard on use of experts, you should have sufficient comfort and knowledge on the competency and capability of those experts. So you can't take it saying for this engagement, let me use this person, another engagement, let me use another person, may not work. So it'll have to be a partnered agreement so that you are well aware of their capabilities and competencies and can meet the documentation requires under the auditing standard. Members with specialization courses, certifications, especially newer areas, as we spoke on a little earlier, on AI, blockchain, data analytic tools, IFRS, Ind AS accreditations. So depending on how many professionals have those accreditations, again, less than 34 marks, more than 50, 12 points fully comes in. So again, this also goes in along with the learning that we had earlier spoke on, where specialized training gets 6 points out of the total. And therefore, you'll have to factor these two and ensuring that most of the staff that you have do undergo these specialized trainings and get the necessary certifications and accreditations. Next is on performance evaluation measures carried out. This again is, annual KPIs are maintained. You look at the performance of employees, map it against those KPIs. How are you then ensuring that they're meeting, not meeting, follow up, regular interaction with your people to make sure they catch up to what is required to be achieved. Frequency of evaluation, is it annual, quarterly, half yearly? Both policy and implementation is necessary. And this is not restricted only to staff. There should also be evaluation of partners. This evaluation of partners is linked to the earlier discussion we had on quality compliance, where you're talking about EQCRs. So an engagement quality review that happens will decide whether the audit file of that partner is meeting the quality standards or not. Depending on those, the partner's evaluation should get carried out. And accordingly, since it's linked to performance, that should also impact his profit share or remuneration that specific partner is deriving. So all of these should get linked. It can't be that I do an evaluation and there's no impact. So there has to be a financial impact as well. The last one that comes in, which only about 88 points that is there, is on overall strategy and function. So here you're looking at three aspects: overall practice management, the infrastructure that is being used, and the credentials that you are forming. When you talk about practice management, again, the requirement is there's a mix of experience in the partners. Now, if you look at it, if the average is less than 5, you get 0 points, which means a firm that is created by recently qualified CAs cannot get into all this. You'll get 0 points on that. So it has to be a mix of experienced and fresh. So if your average experience is 5 to 10, 4 points, above 10, you get full 8 points here. You should have a policy. This again gets linked to what we discussed earlier in the first point, I think in 1.3, where you're talking about quality standards, where you should have policies confirming independence and compliance with code of ethics. So here again, from a practice, you have to review and ensure all employees, including partners, are evaluated for compliance with professional independence, conflict of interest. When you are looking at this, right now it could be manually being done, but intention when you're looking at, again, technology adoption, these all may also need to be adopted technologically, where you have a base of monitoring through a system. So it could be getting annual declarations. You also have to map this with learning to make sure, does your staff have sufficient understanding what it means to be independent, what it is that they need to do to ensure compliance with ethics, which could also cover gifts. A lot of times clients will give you a end of the audit, one party. Okay, not only they go and take you, let's say, to Taj, they gift you one Pia Cardin pen or a silver pen. The pen itself costs some 4,000, 5,000. Now, should your staff accept it? What is your policy? If they've accepted it, does your independence get impacted? Because that could be, as per your policy, high value gift. You may have a criteria which says less than 500 fine, above 500 not to be accepted. The pen itself is 3,000, 4,000. Forget the cost of dinner. Per head dinner there is 2,500. So does this impact our independence for having gone to the audit party? So your policy should cover this, and how are you tracking and complying, ensuring compliance is also key. So it's just not a matter of no financial interest in the company. The extent of independence and compliance with code of ethics expands to a lot of things. The next one is existence of whistleblower policy. Principally, this is no different from what is required for listed companies. Companies also are supposed to have a whistleblower policy. Firms are also supposed to have. Right now, this doesn't extend onto POSH compliance, but principally POSH also is there. So you should have a committee and policy for that as well as for whistleblower. So as I said earlier, when you're talking about human resource, and I said you may need to have somebody designated to manage HR professionally. With these aspects, you may also want to see whether as an organization, should we have somebody called a chief risk officer. Companies have it. Generally the company secretary or somebody takes over the role as a chief risk officer. But as a firm, when you're looking at all these compliances, you should also designate somebody who is a CRO. Next one comes on infrastructure. This is a very interesting scoring. This is done based on number of branches, associates, or network firms. Which means if you're a single office, you get only 2 points. Maximum is 8. If you have 4 to 7, and this is branches or associates or firms within the network and affiliates. If you have 4 to 7, then you get 4 points. If you have more than 15, you get 8. So if you want full, that means that's the extent of expansion you should be having across. And meeting the higher level of points in all these tables becomes crucial, especially if everybody comes back and says you have to at minimum be a level 4 firm to do listed entity audits. Then you can't afford to be sitting at the lower point categories. So you'll all have to start moving towards the higher end of this, which is why I said it may not be possible in a year or two. It will have to be a slightly longer term plan. You can't suddenly say, okay, I've got 5 offices, let me make it 15 in a year's time. Not possible. These are under the institute only, it's there. So before it was only networks, I think now they've brought in a definition for affiliates also. The difference, I think, is when you for a network, all your HR policies, everything will be same. Affiliates, there could be slight differences. But I haven't gone through the rules in detail, so you may just want to see that if you're looking at it. Again, they've gone ahead to look at branch level activities. Is it centralized or decentralized? If it is centralized, you get more points. That means all your payroll processing, accounting, everything is at one place. If it's decentralized with each branch, each office maintaining their own books of account, then you get 4 points. Physical, logical security on information, which means as we spoke earlier, there was another section which covered technology adoption, which said you should have your server or be on cloud. And now this will cover all the VPN, the multi-factor authentications being set up, which again means all staff should probably have mobile phones and it has to be smartphones. And you should have a multi-factor authentication system set up either to receive as SMSs or using authenticators and other aspects. Adequacy and use of data analytic tools, IT infrastructure, and relevant assignments. Principally, this means, again, we spoke earlier on training when we covered the human resource, that you can't just train people on data analytics, that also has to be implemented. And then we spoke on the earlier practice management on technology adoption, that data analytic tools should be deployed on specific engagements. So here again it comes in. So as I said, these are all interlinked. So it's difficult to score in one and not score in the other. So you'll end up scoring in all or not scoring in all. So it's all that variability that falls in. So it's very difficult for people actually to fall within L2, L3. It is more like you're either L1 or L4 sorts sometimes when I start going through all the yes, no's that are there. And it's again linked with human resource again, have adequate infrastructure for remote working, which means you have a dedicated lease line for the office from an internet perspective so that your server works, and VPN is something that is installed on all the systems. So again, which means all staff at minimum, the firm has to sponsor or provide laptops. Otherwise, remote working is not possible. Which means the fact of having manual files, the pads that we used to carry, the green tick or green pen that we are famous for as a logo, that is taking more the back end. Everything is now getting electronic. So ensuring you have infrastructure for remote working will mean that the person should be able to work from home. and therefore should be provided probably a laptop, because having a desktop in office now doesn't help. That doesn't support remote working. So again, as I said when I started this session, the only thing that will turn up is how correct now companies are complaining saying cost of compliance going up. Now auditors also will start complaining saying cost of compliance going up. Practice credentials, again, here, this is the other aspect which has certain negative markings, but again, not too much of a concern. If you are peer reviewed, you get 4 points. If you're not peer certified, you get 0 points. If you're empaneled with RBA and C&AG, you get 8 points. If you're not empaneled, you get 0 points. But if C&AG or somebody has any negative comment on what support you have done and therefore debarred you for some time, you get negative points. If you've undergone any regulatory authority who's evaluated, principally here it will be either RBI or somebody who's got RBI auditors have done for the bank and infrastructure, or NFRA has looked at for some listed companies, and they have some comments or impact on you, gives you negative 10 points. Any assessment that has come out negatively based on the QRB's review, again, minus 5 points. Any professional misconduct because of which you are proven guilty, that will be under the ICAI's review. If you have been, again, minus 5 points. This impact will be when you're talking about misconduct, this is not at partner level. So in a firm, if one partner has had this, the firm gets the negative 5 rating. So again, as I mentioned, there are points to consider. This compliance should be against all branches, including the network firms and affiliates, because that is how you are calculating your compliance in the earlier slide. Before we conclude, when you look at this, it looks totally impractical. But these performance indicators, capacity management principles, ideas, if I look at how the global firms are doing it, they are significantly in compliance, because globally this is a practice most of the large firms follow. So to that extent, there have been some edits that have been made to bring it more Indianized. But even then, the only way this can be complied is we have to start developing connections, networking, growing in size. Just because somebody qualified doesn't become a partner, so you should have structured growth strategies for individuals within the firm. Restrictions arising where only firms meeting L4, L3 may be something we should expect. Right now it is still new. So right now all 4 levels are okay. But 3 years from now, things will start changing, because by then, whoever has been peer reviewed now at minimum will get reviewed then. These gradings will come out on the institute's website for all the firms that have been reviewed. It'll start coming in depending on when peer reviews happen, but max is 3 years from now. Once this starts becoming public news, for listed entities, at least I'm pretty sure audit committees will start taking action. No independent director will risk putting their neck out saying, okay, let me take a level 1 auditor, because they have to explain to shareholders why that is. Evaluation meeting of AQMM could get further extended to all audit firms. Right now, it is only to those firms who are auditing listed entities, banks, insurance, excluding those who are doing branch audits. Few years from now, they may include all those doing branch audits. Next, they may include it to all those who are doing even private company audits, especially once the exemption of certain private companies gets permitted, because then the scope is reduced. They say now all of you meet so many standards. Of course, they might leave it differently, saying for category of these companies, you could be an L1, okay, but you have to be minimum L2 to do this, minimum L3 to do this, and L4 to do listed entities. So compliances and your restrictions of what clients you can accept could come based on your ratings. So that's something I don't expect it to come in the short time, but it is something that you can anticipate will come in the long time, because that's the only way for this profession to move up the ladder. And this also, as you look at the AQMM compliance, a good time to actually go through the institute's policies on how you do networking, how do you set up affiliations, start looking around on how do you set it up to have across India and not be restricted to a specific geography, and how do you set up these systems. Now, why are all this coming in? One thing is, of course, to garner on SQC1, but also if people remember, in 2017, what Mr. Modi had said, saying, why are there only big 4 firms that everybody keeps talking about? Or shouldn't it be big 8 with 4 of them being from India? Now, if you start complying with these AQMMs, that could happen, because having more than 15 offices, having more than 20 people, chartered accountants under each partner, the size that would be required, you could actually get to that. So I presume these AQMM compliance is heading towards that. With that, I bring my session to an end. So if there are any specific questions on any matters, we can take that up. Otherwise, we can conclude the session. Yeah, because this is for the firms whose at least 50% revenue is audit. So significant scope of work is from audit, and therefore you are then called an audit firm, not an accounting firm. So and no comments there. I know I said that that's something you can look at, but possible. As I said, as CAs, we also look for the loophole in the law without breaking the law. So you would not be breaking the requirements by doing that. Yeah. As I said, cost of compliance will go. So you may not want to spin profit making verticals out because somebody has to fund the compliance cost, no? So it's a lot of factors, because that function starts growing, then you'll get into trouble because more than 50% has to be audit revenue. So you may spin off the other less profitable into something else, keep the profitable ones here along with audit. Which means just because you qualified doesn't make you a partner, which was the principally not necessarily what was being practiced earlier, because the day I get my final results and I finish my articleship, I can apply for COP. So you can start on your own, but you can't audit listed entities. So the same thing, if you want to be a firm auditing listed entities, not everybody can be sitting as partners. Somebody has to be the next level. Again, no comments. Again, that's a human resource aspect, because you should have policies on performance-based promotions and demotions, whatever you want to call. Okay, that's all from my end. Thank you.
Thank you, Mr. Jaideep. I hope it was a very knowledge enriching session. As a mark of gratitude and respect, I request our Bangalore branch treasurer to come up on the dais and hand over a memento to our speaker. Even the Q&A. Thank you, members. Thank you for taking out your time and making it convenient to attend today's CP program. Request you to take note on the upcoming programs which our chairman mentioned in the opening remarks. Request you to register. Thank you, everyone. Good night.